Good morning. This is your monthly Real Estate Enigma, where we decipher the real estate market, interest rates, and the general economy. Please like this video, subscribe to the Protea Team channel, and register for notifications for more interest rate and real estate news. We have enjoyed an unprecedented rise in real estate prices since the end of the Great Recession in 2012. The COVID-induced recession saw 20% annual price increases fueled by low inventory, massive government stimulus, and nothing else to buy. In the month under review, home prices continued with its meteoric rise, with the caveat that the most recent data is for March 22, before the Fed tightening started. Active listings in April continued to increase, but are still well below any semblance of normal levels. Days on the market continued its decline in April. The market is still in a seller's market, but not a runaway train seller's market. Construction activity continued to operate near its best levels since before the housing meltdown more than a decade ago. New home inventory is up to a 9-month supply, as opposed to existing homes at a 3-month supply. Inventory is increasing, but remains well below the levels of a year and even 2 years ago. The National Association of Realtors said its pending home sales index in April represented a 6th consecutive monthly decline. The broader economy is wrestling with recession fears, although it is interesting to note that during the last 2 out of 3 recessions, home prices increased during that recession. Inventory is increasing, but prices are expected to remain pretty high. We are all painfully aware of the rise in interest rates in 2022. It has caused much anguish after the Fed's largest hike since 1990. But if we take a longer view, say 30 years, we see that the 30-year fixed conventional mortgage rate has merely returned to the mean. That in itself should not cause outright panic. Here we have the monthly change of the conventional 30-year fixed, the non-qualified 30-year fixed, and the 10-year US Treasury, the driver of these rates. For all the volatility, we've had a flat ending for the month. For us mere humans, it's more important to see how these rates impact our monthly mortgage payments. For the principal and interest payment only, for the 30-year fixed conventional mortgage of $500,000, at the end of this month, we had to pay $46.27 more than if you had taken out the mortgage the previous month. For the non-QM, $800,000 mortgage, the payment increased by $226 per month. If you've been sitting on your hands deciding to buy your dream home, this may be the right time to start taking action. The stock market is generally regarded as the earliest leading economic indicator. We had the Dow Jones decline by 300 points during the month of May, not a major move by any account. The index of leading economic indicators rose for the period under review, but one has to realize that the month delay in the data. We are facing inflation as we haven't seen since the 1980s. At its basic level, inflation resulting in price increases is due to more money chasing fewer goods and services. We are all familiar with the current rising prices in everything we buy. The Fed has decided to combat inflation through a series of interest rate hikes, reducing their balance sheet, or in plain language, the available money supply. This should reduce one side of the equation by reducing the amount of money available to buy things. The other side is the availability of goods and services. COVID shut down virtually the entire supply chain, causing most of today's supply problems. Reducing energy production, gasoline prices, and regulatory problems, baby food shortages, have also not helped. Russia's invasion of the Ukraine put further strain on worldwide supplies of food and energy. More importantly, both COVID and the Russian invasion have graphically demonstrated to the world its over-dependence on supplies from China and Russia, both dictator-led communist societies who are more interested in power than anything else. This realization by the world at large may well lead to the end of globalization, resulting in a reversion to building supply lines at home. Not good news for resolving the supply issues. The Fed is walking a tightrope between reducing money supply and crushing the economy, and may find it difficult to implement an aggressive interest rate hike program. Many of us lived through the traumatic Great Recession between 2008 and 2012. In these days of economic uncertainty coinciding with dramatic increase in home prices that now seems to be taking a breather, we are inclined to rack our brains back to 2008 for similarities, trying to avoid the pitfalls. As history rarely repeats itself in the exact manner, it is worthy to remind ourselves of Mark Twain's words. The older I get, the more clearly I remember things that never happened. Please like this video, subscribe to our channel, click on the notify button so that you will not miss any real estate information, our weekly 2-minute drill and our monthly real estate enigma. Have a great month.